stocks heading for a winning week with all three major averages on track for another record close. Let's bring in 3Fourteen Research co-founder Warren Pies. Warren, thank you for being here. I guess you're sticking with your 2025 S&P target of 6,800. That's about 2% from current levels. So do you think all the gains for the year essentially are captured or reflected at these levels?
We had that coming into the year, and there were times when it looked like a really optimistic target, and now it's looking a little bit less optimistic, but we're going to stick with that. We are going to stick with that. But I do think the big takeaway from the Fed this week is that, there were two, I'd say, big positive developments for the equity market, which at least gives you the hope and the reason why you want to stay long in a bull market. And number one is that there was conventional wisdom that the rates market, so the short-term rates market, had priced in significantly more cuts than what the Fed had signaled back in June. So this put a high bar for the Fed to clear. This was the reasoning out there among traders. And when you study those instances where we've had that before, where there's a great expectation for the Fed, and then what happens next? The Fed moves a little bit towards the market, not all the way. It's actually very positive for equities in the quarter ahead. We saw that last September. We had the market rally over 8% the next quarter. And then we also saw that December of 2023. So that's the first thing I think that gives you hope as an equity bull. And then the second thing is the Fed, the bottom line through all the confusion of the SEP is that the Fed is basically lowering their real Fed funds rate. So that's the nominal Fed funds rate minus their projection for interest rates across every year, 2025, 2026, 2027. Rates are getting lower given their forecast for inflation. You don't want to be underweight equities in that environment.
So then what would you be doing from a portfolio allocation standpoint to, if the market does achieve that 6,800 target by year end, would you be adding to equities now? Would you be waiting for some sort of a pullback to add to equities? Kind of how are you thinking about portfolio construction against that backdrop?
Yeah, that's the thing. We're risk managers. So we're always wondering, we might be bullish, but we're always looking for risks. We're paranoid by nature. And so when we look out at the rest of the year, where does the risk come from? A lot of people are worried about the bond market. A lot of people are worried about inflation and a reacceleration in the economy. That's not our big concern. Our big concern is that there's some kind of a growth scare waiting out there for us. I think there's about let's call it a 1/3 chance that we hit a growth scare over the next few months. And that would be rough for the equity market. It would probably be, if you go back and study those in history, like a 7-8% pullback and more volatility in the equity market. And that would be offset by a rally in the bond market. And so in my mind, if you're an equity investor, you want to press your longs into year end, which is what we're doing. You want to pair that with an overweight bond position. So that's how we're positioned. My best guess is that if we had that growth scare, you'd see the 10-year get down below 3.5, which I know sounds outlandish right now. But that's not our base case, but I think that it's a higher probability than what the market expects. And so that's how we are currently positioned in our portfolios.
Yeah, 10-year around 4.1 now. What do you mean by growth scare? Is that a sentiment indicator? Is that, specific hard data that you're looking at? And, how do equities, as you've studied throughout history, how do they typically respond in instances of a growth scare?
Yeah, growth scare is kind of a thing you hear people throw around. I think it's a good question because people throw it around, they don't really define it. My view as a growth scare is when there starts to be anxiety around a recession that never materializes. Usually you see the unemployment rate pop up a little bit and then settle back down. These, when we study history, and you have a good chart here from our report, when you study history, these kind of occur around soft landing. So we're in this soft landing, muddle through economy right now, where the Fed's trying to land the plane, and then all of a sudden you have some kind of fear around the soft landing not going the way the Fed wants it. So we saw this in the mid-'60s. We saw this in the mid-'80s, a growth scare. We saw it in 1995. There was a growth scare. People probably forget that. 2018, also another soft landing. We saw a growth scare. And then we had one last year. People remember we had a big rally in the bond market, a little bit of a sell-off last August. And that is a classic growth scare type of pattern. So that's what you'd expect. You see rates come down, you see the yield curve flatten, you see unemployment rate pop up a little bit, but not enough to trigger things like the SOM rule. And then you get equities. They still perform when you zoom out, but just more volatility. So you end up having like a 7-8% drawdown within the context of a growth scare. And so again, I think we're in this muddle through soft landing, but if you're trying to prepare yourself for risks, The risk is much more that we're going to worry about the growth. And I think that's what the Fed saw. There are so many questions around the Fed SEP, and how do you square a higher inflation rate with a lower Fed funds rate, lower unemployment next year with a lower Fed funds rate? I think the Fed sees a bigger left tail for the labor market. They're more worried. You heard it in Powell's comments in the press conference. They're more worried than they want to let on about the labor market. And I think you need to prepare your portfolio for that.
Yeah, all about risk management right now, both at the Fed and for you, Warren. Thank you so much for your time today. Appreciate it.